Good morning, everybody. Hey, welcome to Friday. It is April 22nd. We got one more full week of April to go. And this is really the first month of earnings season. We'll talk about that and more when Dave joins us in just a few moments, because the markets really went crazy yesterday to the wrong direction. We'll talk about that more also when Dave joins us here in just a few moments. But before we do that, please remember that there's only one thing that any of us can control when it comes to your portfolio and the markets, and that's how much risk you have. If you don't know what your risk is, that means it's even more important that you walk through our core retirement design, where we can help you design the retirement you always dreamed of. Give us a call at 863-382-0037. And with that, we've got Dave coming up next.
That's Taylor Swift there at 0.7 Light FM. We're at 8:40 now, 20 before 9. It's time to check in one more time for the week as to how the stock markets are treating your IRA and 401k. We've had a couple of pretty good days this week. Yesterday, not necessarily one of them. Let's see if we can figure out why with the resources of Phillip Statler from Statler Financial Services. Phillip, good morning. How you doing today?
Good morning, Dave. How you doing? Well, today it is Friday, so excited that it's Friday.
Oh, it's a relief that it's Friday. And yesterday, and probably there are some investors that are relieved too, because I look at the charts from yesterday. We started out okay and just kind of slid downhill. It was just kind of like putting the car in neutral and just letting it slow down for the whole day. There just wasn't any energy on any of the markets yesterday, was there?
No, there really wasn't. And so I'm looking at the weekly numbers, and the Dow still, as long as they can eke out a gain today, should stay positive for the week. They're up 1% right now as of yesterday's close. The S&P 500 is basically flat right now. So if it loses today, it'll have a loss for the week. NASDAQ, it's got to have a pretty good bump today to get to positive territory. It's down 1.3% already.
And that's almost a surprise that it's only down that much, because we've had some 2% negative swings on the NASDAQ, even just this week alone. Yesterday, the Dow was down by a full percent, down 368 points, 1.5% down on the S&P, and 2.07%, 278 points on the NASDAQ. And there really wasn't a heavy-duty reason for it. It was just a general drift downhill. There's no knees in the curve that showed one event that scared investors. It just went downhill from the start, and we never had any indication that there was any reason anybody wanted to buy anything.
Well, that's right. I mean, let's face it. It opened up tremendously, right? I think the Dow was up like 300 something points and ended up down 368. I mean, it was a 2-point swing for the day. And the other indexes kind of were in the same boat. So it was definitely, but we closed off the lows. I will say that. I think we got lower than that during the day, according to the report I read. And so, it is what it is. We continue to face inflation and interest rate issues. And Paulson came out yesterday basically and said, betting on a 0.5 point in May for a increase in interest rates. And so, yeah, I think the problem is that the market has a certain amount of interest increases built in. And I'm thinking that they think now that yesterday caught them by surprise. I think they're thinking there may be a couple more before the end of the year.
Oh, and we got Bullard talking about a 0.75% bump all in one meeting. He's always been a hawk. So when he starts talking about that, then Paulson comes out and talks about 0.5% increases. The 0.25% rate increases, I think the market can handle. I think it's the size at any given time that also kind of puts the market in stinking thinking, because you can cope with a gradual increase, but 0.5% in one poke, or God forbid, 0.75% in one poke for stock prices, that's not good news, even if we all know we need the increase.
That's right. Even if we know it's coming, right? It's still not good news. And so the futures are kind of reflecting that this morning.
Using my analogy of castor oil, it's kind of like having you take the whole bottle at once.
Yeah.
You're probably going to have a really pleasant next 24 hours or so after you do that.
Hey, it'll clean out the system, right?
That's true. The other thing Paulson said that I thought might very well have attracted some eyeballs was he called the labor market, quote, tight to an unhealthy level. Nothing like it when your Federal Reserve Chairman says we need to fire some more people, right?
Yeah, that's right. And it specifically, talked about, and at least the report I looked at specifically talked about the people retiring early, taking early retirement and getting out of the system because of all the COVID issues, as well as people still living somewhat in fear of COVID and not wanting to go back to work.
Oh yeah, and unfortunately, I think we're all pretty much coming to the conclusion those waves of COVID, where we're going to have people dropping out of work for a little while, I think they're probably going to be with us on a semi-permanent basis, whether we like it or not. Don't you?
I think it's going to be like flu season. You're going to have waves of flu that come through during flu season and knock a bunch of people out of the employment issue for a little while, but hey, they'll recover and come back. So it is something we're going to have to continue to deal with. But Paulson's right. We don't have enough employees. I mean, there's less than 1.5 million folks collecting unemployment right now. And there's 10 million job openings right now. So go figure.
Oh, absolutely. I mean, his phrase that it's tight to an unhealthy level is not inaccurate, but it's one of those phrases I don't expect the Federal Reserve Chairman to use in general public. You know what I mean?
Yeah. And the other part of that is, how do you fix it?
Yeah.
You can't all of a sudden add more people to the job roles.
Yeah, and increasing interest rates is going to fix it the wrong way. It's going to cut back the number of job openings. So, hey, it'll be considered good news when we only have 8 job openings for every unemployed person, right?
Exactly.
What's wrong with that picture? The other thing that came out yesterday I found interesting, after earlier in the week we had the World Bank and the IMF cutting their outlooks for global economic growth, everybody got a little bit, watch out. Well, Goldman Sachs comes out with something, and my tip sheet is calling this bad news. I'm calling it good news. Goldman Sachs comes out with a statement where their chief economist concluded there's roughly a 35% chance the U.S. economy will go into recession within a couple of years. And I'm saying, okay, I'm considering that good news. Number one, less than 50-50. And number two, they're extending the window out. I think a lot of investors are pricing in a near-term recession. And we've been talking about this for a few days now. All the building blocks aren't there for a recession, especially with the unemployment as low as it is. Goldman Sachs is now saying it's less than 50-50 for 2 years.
Yeah, that does sound a little better than what a lot of them had been talking about. So, and that's what, 65% chance we won't have a recession, right? So if you look at it from that perspective, I think that could be some good news.
Absolutely. And I mean, Goldman Sachs is not some dweeb in his underwear sitting in an apartment in New York City writing a blog. They're a relatively credible source of information, too.
Well, that's true. So, but
of course, some of the guys are sitting around in apartments in New York in their underwear because they can't get their employees to come back to work. Talking about working at home. We've got earnings season going on, and I got absolutely nothing macro-wise coming out until almost 10 o'clock this morning. Have we got anything that can push us up in the quarterly reports?
Hey, we do have a couple things, but before we do that, let's talk about one other macro thing, and that's interest rates, Dave.
Oh, yeah.
Let's look at, because something came across my little ticker saying the 5-year was at 3%. Man, that got my attention in a hurry. So I went looking. And actually the 5 years gone up since you and I went on the air. It's at 2.99% right now. And so it is right now inverted against the 10-year and the 30-year. So that's not good news. Now, obviously, you asked me before we were on the air that definitely lent a little bit more credibility to a recessionary period of time, but it's not a real big spread, right? It's a spread. It's something we need to continue to watch, but it's not a huge differential between the two. So we'll continue to monitor that to see how big that gap gets between the 5 and the 10 and the 5 and the 30 before we start really starting to ramp up and think, well, maybe we are closer to a recession.
Yeah, it does tend to get to the point, and because we've cried wolf a couple of times in a recession, didn't follow an inversion on the interest rates. I kind of get the feeling the big money investors are looking this kind of, they're not ignoring it, but they're kind of looking at it askance and saying, okay, it doesn't seem to be an immutable law when these things get inverted. A recession's on its way, so we're kind of not overreacting to it this time like we did a few years ago when it happened.
That's right. Yep. So just something else we need to keep an eye on. as we
Yeah.
continue to watch the markets. And so now we go into earnings season, right? A big deal. So we had American Express was probably going to be working on the headline there. They beat on profit and revenue for the first quarter. And so they've been helped out by spending. The millennials and the Gen Xers are starting to pick up spending a little bit, as well as small to medium-sized businesses are spending money. So Amex is liking that. It's not up as much as it was. It was up substantially earlier. It's up less than 0.2% right now. So that just kind of indicates the noodling going on in the indexes right now.
And kind of the indication we've had with income growth being outstripped by inflation, it's evident that we're burning more plastic, and Amex is benefiting from that. Absolutely
are. The other one I have Verizon. Verizon matched expectations on both earnings and revenue. The number they watch on phone companies is subscriber rates, and Verizon lost 36,000 phone subscribers during the quarter. And that sounds terrible, but it's better than the analysts expected. They expected almost 50,000 losses. So a little better than expected, but they're still taking it on the chin this morning, down 2.5%.
Did they say they're losing them to the resellers or to other of the big three?
It did not say where it was coming from.
Because all those ads on the radio talking about, how you can get same coverage, same system and everything, 5G and all of that for half the price. I got to believe some of these big name cell phone companies like AT&T, Verizon, they're losing to the resellers more than they are each other these days.
And that could very well be. I know a lot of folks have moved to those. And I'm not sure exactly what the battle plan is going to be for the big three to combat some of that, but I'm sure they're working on something.
Understood.
We have Kimberly-Clark, the consumer products company. They had better than expected earnings and revenue. They've been able to really deal with the volatile and the inflationary environment that they find themselves in. And they didn't raise their full year forecast, but they raised their full year organic sales forecast and internal growth. So they're up. Man, they may be a big winner today, Dave. They're up 5.5%.
Cool. I can't help but giggle at the notion of a toilet paper manufacturer talking about an organic forecast. That was the snort that you heard.
We have, I got a couple more for you, Dave. I've got Schlumberg. They're one of the oil producers. They beat estimates by a penny a share. Revenue top forecast, and they are heading up 1.85% this morning. Now, the last two I have for you are kind of a mixed bag. We have Snap, the social media company. They lost 2 cents a share, but they better than expected. No, I'm sorry. They were expected to make a penny a share, so they lost 3 cents more than expected. But they've issued some outlook that looked good, so they're up about 0.5% this morning. Get
Guidance
this one,
is
Dave.
definitely driving the stocks this time, isn't it?
It is. And get this one. I just don't understand why it's not down more unless something's wrong in the report I've gotten. And that's the only thing I can see. But Boston Beer, they reported Samuel Adams. They lost 16 cents a share. Now, the analyst, my report says that the analyst expected a profit of $1.97 a share. Now, that's a big difference, Dave.
That would make me run for the hills if I were an investor.
And revenue missed. Shipping volume was down 25%. So I'm thinking this should be like the one we saw the other day, down 10, 15, 20%.
Yeah.
It's down 2.6% this morning.
Weird.
Now, it will be a new 52-week low. I'll give you that. Prior, it was $342. It's right now, it would open at $337. So still 52-week low. But when I read the report and then I looked at the trading, I thought, well, there's a mismatch here, but evidently not. It's been holding right in there.
Maybe it was that they understood it was coming, so consequently they priced it in. But good heavens, that's going out of business kind of numbers, and the market isn't really responding that negatively, are they?
No, they're really not.
I neglected to ask this before we got into the specifics, but you had a tip sheet reading on the on earnings season so far, which probably will add a little bit more blue sky to our bad news on Sam Adams. The earnings season so far has not been that bad, has it?
It really hasn't. Now only 17% of the S&P 500 has reported as of the open Thursday morning, but of that, 81% have beat analyst expectations.
You can't all be Sam Adams.
Exactly. Right. You're right.
So it hasn't been that bad so far. Resetting the table, off day yesterday, just a general drift downward on all the indexes. 45 minutes before we open, Phillip, what are we looking at?
So right now, Dave, it has continued to get worse, as you and I have spoken this morning. We've got the Dow down almost 0.4% right now. It's $128. It's the big loser right now. We've got the S&P 500 down 0.25%, and the NASDAQ 100 is basically flat right now. We look at the commodity side, it's given back big time today too. We got silver down another 1.2%. Gold is down 0.5%, and crude oil is down another 1%, 102.77 for a barrel of oil.
And 100 be far away now. We can cross our fingers. The only
commodity getting close.
Yep, the only one we want to see go down. The overseas markets, mixed bag in the Asian rim. Europe is looking us and going, ugh, they're all down a little bit this morning as well, halfway through their day. Keeping tabs on retirement, trying to make sure that you can retire, that takes advice. How do I find you to get advice on that, Phillip?
Hey, that's the reason we developed our core retirement design to help people design the retirement they always dreamed of. Give us a call at 863-382-0037 to start working on your core retirement design. And then catch us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and 95.3 FM.
And next week, right here every morning on Light FM. Phillip, you have a dynamite weekend. We'll see you Monday.
All right, you too, Dave.
Thank you, sir. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us. I hope that your week has gone well. Have a great weekend. I look forward to speaking to you again on Monday. Bye now.